All right, let's get started. Welcome everyone. We see about 53 odd people joining us for this COVID-19 Adapt and Responding to Affluent Consumers Investment Habits webinar, which is brought to you by Isentia and RHB Bank. Today we have three panelists who will be discussing more around these investment habits. We have David from RHB, Alfred from Aberdeen, and then Casey from RHB as well. So we'll have the panelists introduce themselves to you in a bit. Before that, let's start looking into what are we going to cover in the next 1 hour. So in this webinar, it's more interactive in nature, and there will be less slides and more questions and discussions. We'll start with essentially looking at the attitudes of affluent consumers when it comes to investment, and what do our panelists think in terms of how these habits have been, how they have changed, and what may change in future. The second topic would be around using some of the insights that we have uncovered on affluent consumers and what our panelists think about these insights in terms of do they agree, disagree, or do they have a different point of view. And finally, we'll take in questions from the audiences, which would be around affluent consumers, their investment habits, and then how can they better adapt and respond to such investment habits. And if we have some affluent consumers also joining us, then it's more around seeing investment in general and learning from our panelists. So with this out of our way, let's get started with the panelists and the outlook. So we will go alphabetical first, and then we will open this webinar up. So let's start with Alfred. We'll go to David, and then we'll go to Casey. Over to you, Alfred.
Thank you. So my name is Alfred Fu. I work for a mutual fund unit trust company called Aberdeen Standard Investments. I've been there for 2 years. And basically Aberdeen Standard is quite well known in Singapore. We've been in Singapore since 1992. A global investment house. We have more than 1,000 investment people. We manage around $650 billion. And in Singapore, my role is basically to take care of distributions across all channels, from banks to insurance companies, to financial advisors, and also the platforms. And prior to joining Aberdeen Standard, I actually worked in the banks, private banks in Standard Chartered and also Credit Suisse. So I have a range of experience altogether. I've been in the financial industry for the past 17 years or so. And with that said, Prashant, do you want me to just straight away answer, or just let everyone introduce themselves first?
Go ahead, Alfred.
Okay. So I think the first question was the outlook on affluent consumer investment habits. When I think of affluent investor, comes to me a couple things. One, the affluent investors today, they are able to access a lot of different things. And what the affluent investors are looking for is differentiation, meaning, we don't want the same old that I can get when I walk into a bank, or I log on to a fund supermarket and buy something like that. I want something that's different than what I can usually get out there. So that's the one thing that we find affluent investors are looking for. The other thing that affluent investors are looking for now is also better advice. And let's face it, it's hard, and for most investors today, to be able to stay invested and follow, the financial 101 that was taught to us, which is, buy, stay invested, don't go away when markets fall, look for opportunities. Even though that's all ingrained in us, it's very hard to do. So affluent investors want someone to consistently guide them, not necessarily drive for them, but to guide them. And we find that, advice, which has been a big deal in the Western worlds, from UK, Europe to the US, is slowly, making its way to Asia as something that's very important. I use the example, if today we get into a legal issue, we walk into a lawyer's office, right? But today, if we get into a financial situation, we might still try to deal it with ourselves, our own self, rather than talking with a financial advisor, a banker, to understand how to make sure we're doing the right things. So that's what we see, the two trends. I'll go back to that first one, which I mentioned, the differentiation in product. So one product that we're seeing a lot more demand, especially the past 2-3 years now, is something called fixed maturity portfolios. It's basically a product that is an in-between for a single bond and a bond fund. So for most of us here who are investors, we know what a single bond is. You buy a bond from, let's say, a DBS or let's say Singtel. It's got a tenure that's, let's say, 5 years or 4 years. They give you, a coupon, which could be, 3, 4, 2%, whatever it is. And then at the end of the tenure, you get your principal back, right? So that's a single bond. Now, we have clients who, rather than put all their hope and faith into one company bond, they go into something called a bond fund, a unit trust that will buy 50, 100, maybe 200 different bonds. And what happens is, instead of you taking a single country risk, now it's a product that that's more diversified. Now, the downside is you don't know, because there's no ending date for a bond fund, when you're going to get your principal back. Instead, it's going to go on and on and on and on. So what happens is clients who invest in the bond fund, they might not know when to sell out. They might not know when to get out of the fund during good times, bad times, whatever the times is. So the demand in the market that we're seeing in the past 2 or 3 years now is a trend where it's an in-between product, something called a fixed maturity portfolio, whereby banks, especially private banks, have been selling a lot of this. They offer a product in conjunction with a fund house where it will buy a select number of bonds, let's say about 50 to 60. However, all those bonds will mature within a certain tenure, be it 3 years, be it 4 years. So this way, this FMP, or fixed maturity portfolio, sits between a single fund and a bond fund. It has a fixed maturity, so in 3 or 4 years, get your money back. But at the same time, you're investing in more than one single company bond. So this way, you spread your risk out. And we've seen billions of dollars going into this product. We see the advantage of this product because, one, it's more diversified. 2, it's got a fixed tenure, which people like. And then 3, it's being professionally managed by a fund house to make sure you have constantly someone that's monitoring to make sure the bonds that they buy in that portfolio are still doing what they're supposed to do. So that's just a trend that we're seeing the past few years on a product that is in demand by affluent investors that is different than what's out there, which would be a single bond or a unit trust that goes into a fixed income product. So I'll stop there. I don't want to take too much time, but that we're seeing a lot of trends as far as differentiation in products, and we're seeing advice or affluent clients, customers looking for better targeted advice.
Thanks, Alfred. And that's a great insight in terms of diversification. When can you go in and out as the market changes and it fluctuates right now? Let's go to David and really understand your experience and also about your insights on how we are seeing affluent.
Hi, I'm David. So currently I'm working as the Treasury Investment Product Manager, where I take care of, like my role mentioned, the Treasury and investment products in this bank. So what I do is I provide support to the RMs in terms of where do we think the market will go, what kind of direction are we heading, where the potential opportunities that we see in the market right now, and also how do we cater to the respective needs of the clients. So prior to this, I was actually from the banking advisory. I started my career out there from when I graduated, and I moved on to private equity, where I did business valuation, corporate finance, so fundraising. After that, I moved on to fund management, where I did a lot of portfolio management and so the real estate development loans. So that's how I structure a lot of other instruments as well. So right now I'm here at RHB Bank. I'm here to help. So I'll just keep it short. So in terms of the affluent consumer investment habits, currently we do see two sides of the camps. Like Alfred did mention, there's a high demand for hybrid instruments. It's kind of similar to how we are seeing the 2007 crisis, right? Things start to move. The affluents start to have a different mindset compared to the mass. So right now we see a shift. Previously we see a shift in terms of funds towards private funds. Right now we are seeing hybrid instruments getting more popular. We see bonds investment actually getting more and more. So the affluents are actually reaching out to gather these cheap assets, as we can say. So this is kind of the two sides of the camp. The first side of the camp is those affluent, the affluent people who actually went through the 2007 crisis. So they do understand that there are opportunities in the recent dip. The other side of the camp will be the recently affluent people. So they are not staying still. That's what I meant. They're actually being more active. They're actually reaching out to find out where are the other opportunities that they can find in the market. So from what we are seeing right now, right? In 2007, we see the influx of funds towards private funds, towards property funds, property investments, and so slightly in bonds. Right now, we do see a same tectonic shift. So we don't see potential in the property segment. So like what Alfred has mentioned, hybrid funds, bonds, investments, we can see evidently that a lot of rich people in Singapore are buying into cheap shares. That's why the SGX actually broke the $10 mark last month. We can see that. That's quite supportive for our view. So I won't share more about the relevant views that we have. That I'll leave it to the RMs to actually engage the clients. So that is actually where we are seeing now the influx of funds towards hybrid instruments, as well as the traditional banking assets. They are not being left out as well. UTs, bonds, these are the unit trusts. I mean, these are areas that we see regarding more as AUMs as investors think that it's a good opportunity to go into.
Yeah. Got it, David. Let's move on to Casey.
Hi, good afternoon. My name is Ken Chong. I'm leading the Wealth Advisory Desk in RHB Retail Banking. So what we do is to customize and curate wealth solutions for our clients. Prior to joining RHB, I work in the private client space in DBS, and I also lead the teams in the offshore teams in OCBC and CIMB as well. And coming over to RHB to lead the Wealth Advisory Desk. Onto this topic, when I first look at the topics that we have today, so I was wondering whether to share more on the investment aspect or on the other side of the investment, our financial literacy that we should be looking at. Because if you look at the title today, the three keywords here are adaptation, responsiveness, and habits. So that's a common denominator here, and which is behavior. So I think this is something that is very lacking, whether it's for affluent customers or high net worth clients as well. All right, the behavioral investment is something that for the last 30 years, where market has average return of 11%, where investors only manage to capture 4% due to emotional investment. So today, I think I'll touch more on how are we going to bridge this gap. And also I'm going to explain to you why women are better investors than men. All right. Yes, you heard me correctly. When we talk about emotional investment, it appears that women are actually better investors than men. So they'll be sharing some facts and findings and research on the data on this. And then there'll be some interactive tests for you as well to see how you respond, all right, to the habits or how you shape your habits in terms of investment for oneself. All right. Thank you.
Thanks, Casey. And that's a great insight in terms of how emotional investors are. And we saw that even in the NASDAQ crash and NASDAQ going up, replicating the 2008 crisis. And then how it was the new high when COVID was there in Asia. And when it started reaching European borders, there was a new low. So some really great pieces of insights here. Let's try to understand what's happening with what these discussions are on social media, and then see what people are searching around, and then get to know your views around it. And Casey, we would love to know more about those quizzes that you have in mind. All right, so let's start with the methodology first. So the first one, what we looked at was social media conversations around affluent investments. And here we were looking purely into Singapore because that's the nature of the discussion right now. And we also looked at what people are searching about, because not all affluent consumers may want to talk about their investment habits on social, but a lot of them might be searching around some specific keywords and specific terms that they may have in mind. For example, diversified bonds, or let's say, for example, a fixed income product. So then we try to populate the trends around these and what are the most common and prominent emerging trends from social media as well as from search. And finally, we put it all together to share with you guys in terms of what do you think about them. So let's start with the first one. The first one is around planning for long term. It's not new, but it has gotten some sort of spike recently. CPF is an ongoing conversation. People are looking to invest some of their CPF through a special account. But what we saw during the COVID times is all about retirement account, endow us, coming up as a keyword, and also SRS accounts. And these are all around investing your CPF money and also retirement savings into something which is more predictable. It came in because we think that the psychology behind it is all about the uncertainty. And when people are thrown into a times of uncertainty where they don't know what's going to come in short or midterm, then they end up going into a more comfort zone. And this comfort zone is where the whole long-term planning comes in, where they are looking to reap investment rewards over long term rather than get short-term in and out. So what we saw here was that there was a significant buzz in terms of investing in stock markets, which have been quite volatile. And people are saying that, look, what about my retirement saving? And how can I use my CPF accounts in a prudent manner? People were also discussing about getting more risk-free through their CPF special accounts, and then say whether it's high or low interest rates. There was a lot of chatter around endows, and we also saw that a lot of them were talking about blue chip stocks and then how to invest their retirement portfolios in it. So just want to get more understanding from the panel here in terms of what do you think around the investment habits, thinking from a long-term perspective, especially the CPF and your retirement accounts. We can go with anyone, so whoever is ready.
Okay, maybe I'll start first. As what David has correctly pointed out, I think this time around we face a crisis that, of course, every crisis has a huge impact on the economic behavior. And of course, let's not forget that we have this huge financial experiment back in year 2008. And many of us, I think it's very impressionable because like for myself, who are maybe in the 40s, or those people who are in the 40s, you just started work for a couple of years, you get some savings and you put it into your CPF, you put it into your savings account, and then you put it into some investments. And the next thing you know, everything is swept up by half, all right, because of the crisis. And that actually shaped the behavior of investors, okay, from that point of time. People get more risk averse. They start to own what is most familiar to them, rather than being diversified, because such behaviors actually constrain diversification or portfolio diversification. All right, and that brings that behavior back to here today, where we're seeing another crisis here. Just that the major difference here is that back in 2008, it's more towards a structural issue, where now it's more like a pandemic that's going to influence the behavior, or rather a shift in demand for products and services, and also the asset allocation within that portfolio as well. Now, to put it very loosely in categories, there's three categories that we're looking at. Long-term recovery, that's sectors we're looking at: airlines and tourism. We look at long-term stability, luxury goods, pharmaceutical, and we look at long-term growth, your 5G's network and your collaboration software like Zoom. Now, having said that, I think CPF investment, I mean, there will be questions like, oh, should I invest my CPF funds? Now, there's two thoughts about it. We know that it pays you, your ordinary account pays about 2.5%, right? So it's either you're going to take that as a hedging instrument, which means you don't invest at all right? You just invest on the cash. And until the day that you see a crisis, that you see values, so you go by value strategy, picking of stocks, and then you get your CPF out of that 2.5 because it's risk-free, you get it out of it and go for some value stocks or value investments over here. Now that's how you want to hedge it. Or it could be the other way around. You ride on the bull run for the last 11 years because you know that you're going to achieve like 4% or 5% higher than that 2.5. And then when crisis comes in, well, I'll just liquidate my assets and put it into the CPF account and hedge my position at a risk-free at 2.5%, right? Now, having said that, at RHB, what we're going to do, of course, we try to enhance the resilience of the portfolios, especially right now. It could sound boring because it's still back to basic on diversification. So basically, our arms try to construct a portfolio that it consists of the core and the diversifier, where the core portfolio provides broad foundation like your US stocks, large cap international, global investment grade bonds as well. The diversifier will consist on, or rather that offers diversification and offer potential higher returns. And that includes your emerging market stocks, emerging market debts in US dollars, high yield bonds, commodities, global infrastructure, or global risks as well. Now, if you want to increase your probability of achieving your desired goals and avoid losses, of course, you have to add in alternatives. And that's where we provide solutions on structured instruments that capture both the upside and the downside, all right? But having said this, I think what we need, or rather what's the most powerful thing that we can do is, of course, to keep our clients in their seats, okay, or keep them on their path, because there's no certainty, all right? You and me, we wouldn't know which stocks is going to outperform the rest. But the only certainty that we can provide for our clients is to keep our clients in their seat and ride through it. And I think that's the most powerful thing that we can do. Because if back in year 2008, you put in a lump sum of investment, and you ride it through all the way till now, you probably would have double or even triple your funds. So if that's the definition of long-term investment, we think that we need two key strategies here, where on diversification of your portfolio and also keeping our clients on course, or keeping them in their seats.
That's a good point, Casey. Let's go to David and Alfred. What do you guys think about this trend around long-term investing of retirement funds?
Probably I'll start first. Sorry, Alfred. Yeah. So I mean, I agree with what Casey has mentioned in terms of the how we see cash and CPF investment. But for me personally, it's kind of a straightforward thing, right? For CPF, first thing, you can't take it out. So what are the available instruments for you to use? First thing, you can put it inside the OA account, where you get like Casey mentioned, 2.5% interest, or you can use it to invest. Right now, we are seeing opportunities in the market. Things are getting cheaper, risk assets are getting cheaper. So we do see opportunities there. But then again, how long do we have to keep it vested? Like I mentioned, if you can't take it out, stay vested. As any RS will probably tell you, if you are to miss the top 10 days in the top 10 trading days in the year, your returns will probably be half. So right now, there will be short-term volatility. We do see like the reference, our Dow Jones index trading about range bound. We don't see a lot of huge bullish signal, huge bearish signal as well. The second wave may come, the second wave of COVID infection may come, bringing the markets down a bit. But in any case, if you are staying invested, that shouldn't be a problem at all. Because what we want to do is stay invested, get more than our benchmark, always to get more than the 2.5% that the current CPF is paying. And we feel that given the current valuations of the risk assets, this may be possible. So that's why we are saying, if you are going to use your CPF money, stay invested. The cash, you can be maneuverable. You can go into different asset class, can go into structured products and the bonds, the singular bonds, and also like the hybrid products like Alfred mentioned, the fixed maturity products. So these are the available assets that we can actually utilize to enhance our yield, given the current low yield environment that we're having.
I'll add a few points. I think, what Prashant mentioned, long-term investment, and I think over the conversation we talked about staying invested. This is, to be honest, relatively new-ish term when it comes to investors in Asia. I got the benefit of working in the US for about almost 13 years in the US, and their mentality of investments have actually been what if you want to call it brainwash or whatever, but it's more of a long, they do think more in the long term. They do think that it's harder for them to be able to influence and pick the right single stocks or single bonds to beat the market. So they've managed to move away from trying to do it yourself to say, let's outsource to a fund house, a unit trust, a mutual fund, a banker to give me the appropriate advice so that I'm doing the right thing. Versus in Asia, I think 2008, even though when we look back, it was quite a bad time for us, it didn't affect Asian investors that much. In fact, if you look further, Asian investors have been quite lucky. They've done well, even if you pick your own things for a long time. Now, unfortunately, things have to go back to normal, and the normal thing is there's going to be bull market, there's going to be bear market, right? So what we're seeing right now is a bear market, and it's a good opportunity to refocus and to think really about what a long-term investing should be. So we talked about CPF. Aberdeen Standard have about 11 funds on the CPF platform, and we've got investors in out, but we are one of the largest in there. I will pick on one particular fund, one of our largest, one of the longest fund in the CPF platform, and it's the Aberdeen Standard Pacific Equity Fund. No particular reason why I'm picking that, but it's just because it's got a long-term track record. So if you had invested in this fund, and just to give you a little bit about this fund, it invests in Asia stocks, India, China, Malaysia, Thailand, Singapore, all that. So it basically buys all Asian stocks. So the fund has been around since 1997. Now, if you started investing this year, January 1st, 2020, you said, hey, I've got a certain amount of money, it's in CPF, I'm going to put some of it into this fund. Come end of March, in 3 months, you would be down 16%. So you put in $100, you are now down to $84. I mean, that's a lousy experience, right? And just in 1 month, the month of March, if you had invested March 1st and you end at March 31st, you would be down 13%. Now again, lousy experience. But for those investors who have been in it longer, and when I say long, go back 5, 10, 15, the best would be if you go back all the way to 1997, if you had put in money since then, on an average annual return basis, after expenses, this is what the investor gets. You would be averaging 8.1%. And this is taking into effect 97 crisis with Asian stocks, the 2000 internet bubble, the 2008 global financial crisis, and what happened in March this year. So this is where I think the understanding that long-term investing can really make money for investors. It's just you gotta be disciplined, be focused, and not to run in and out. And especially when you see, I just give you the example of investing in 1 month or 3 months, seeing the lousy returns and then giving up.
Thanks, Alfred. Yes, the power of compound interest really acts in whichever bubble you're going through, but then in the end, the long-term investing does win. And it's good to see that Asian investors are also talking more about it rather than finding the next big thing to invest in. Let's move on to the next trend. And this is around, and I'm sure if you are watching a YouTube video, you would have stumbled upon this one, which is the financial guru courses. Now, these can be people who are talking about real estate investments, or who are talking about, hey, I have the next big thing in terms of where you should be selling online and which product to sell on Amazon, or essentially how to invest in Forex. We also saw some influencers and some comedians also jumping into this. So that's a trend that's coming up, and this trend is more towards the negative side, wherein people are talking about that all these scams have actually propped up. And this might be due to the fact that there have been job losses, there have been income cuts, and because of that, people are thinking of having a side income. we are in a situation wherein it's not a total recession because there are categories that are doing very well right now and they are dealing with overwhelming demand versus others that are actually struggling. So with this sort of dilemma that's happening with the investors right now, this trend popped up, which was all about the self-proclaimed financial guru courses. And what we saw in these trends was all about that they are targeting a lot of vulnerable population, for example, older victims. And this is because of the digitalization, because of how we are all sort of, in a circuit breaker situation and going digital. And as we go digital, especially the older folks going digital, they also succumb to some of these advertising because it's the first time they are seeing it. So such conversations started coming up on social. And this is something that I want to discuss with you guys in terms of what do you think of such things happening and how should affluent investors be looking at it? Who wants to go first?
I guess I'll start then. Like, this has always been an interesting topic, right? Financial guru. So we all want to make money fast. I mean, quick money, who doesn't want that, right? But I guess it only boils down to one thing, because right now, if we are at the bottom of, we are at the pit. For example, right now, the crisis has brought the Dow Jones Index has brought down about 38% from the peak. So anything that probably when you call for a buy-in at about 35% to 30%, you will likely be right. But does that make you a guru? That will be the key question. We need a certain track record to make sense, right? We do see a lot of conversation regarding like, oh yeah, he mentioned that you should buy into US, or he mentioned that you should buy into Asia. But these are the things that we deem it as lacking credibility or accountability. It's similar to going to a restaurant. You want a restaurant to be there and then the next day, right? If anything were to go wrong, if you were to have a tummy ache, you want it to be there. You need to seek some assurance. For us, gurus are kind of like a food truck. Some may be good, but you don't know which one are the toxic one. So we can't really find them when things are going bad. So we think that accountability is one of the key things that a bank or a financial institute can actually offer. So in this case, yes, guru may sometimes be right, but we do need to see track record. That will be the key thing. What is the house view? What is the house view they are pushing? For example, if we look at other peer banks other than RHB, we see during the month of March and April, we do see a lot of banks pushing for Asia market investing. But we actually pushed for US market investing. And it brought us some goodwill because for the month of April, US market actually surged the most compared to the Asia region. So that's where we get a goodwill from. Of course, we don't want to harp on it saying, oh, we are the guru, because we are working for a long-term instead of a short-term investing period. So that's where we're seeing this kind of trend.
Casey, Alfred?
Alfred, Alfred, you can go first, Alfred. Yeah.
Sure. Thanks, Casey. Yeah, I was actually going to use a very similar analogy, but I'm a football fan, so I'll use the football analogy. So let's face it, investing can be very simple, right? You have a certain amount of money. You know when you need this money for. Most people would need it for retirement. Most people might have 10, 15, 20, 30 years until retirement. So you got a time period. So during that period, you need to make sure you invest that money appropriately so that when you do need the money, it's there. Hopefully it's higher. And then, you'll use it for the next, 10, 15, 20, 30 years, whatever it is, right? So it's very simple from the basis of it. The problem is, we, human nature, we like excitement, okay? So the analogy I use is football, because I like to watch games, to see all the players, right? And then once the game is over, I'll call my friends or I'll watch, YouTube or wherever, and there'll be people talking about specific players. Hey, so-and-so didn't run as fast. So-and-so should be sold. So-and-so is, a really strong player. We should pay him more. Everybody's got their opinion on a so-and-so player, right? But, if you are, if you take a step back, you should look at it as, did the team win? Yes. If the team won, doesn't matter if you have 9 lousy players and 2 very strong players, because what happens is you have a pool of of diversified people that is working along as a team to make sure you get your result. Same thing with investments. You gotta, before you watch, all these gurus telling you, buy US stocks, buy this bond, buy this company. You need to have your own plan first. And then once you have your own plan, feel free, listen to all this, gurus talking about whatever they want, but know that for the majority of your money, you already have a plan and you're sticking to it.
Thank you. From food trucks to football, what do we have, Casey?
Okay, I think Alfred has set a stage for what I'm going to say. We talk about human nature. We talk about self-realization as well. I think going to guru courses, going to banks and stuff like this, we are talking about education here. And of course, financial education is the biggest asset I think one can have. Now, at RHB, we place very great emphasis on educating our clients and of course our own RMs, relationship managers as well. But we think that market and technical knowledge is important, but not good enough. So that brings us back to the desk, okay, and work on how can we work better, okay, on the psychological aspect of investment, okay, and that brings me that do your RMs actually ask you if you have been through the year 2008 crisis before they do any financial needs analysis? Now, truth to be told, I think the F&A, the financial needs analysis alone is not good enough, all right, to determine an investor's behavior, because your arms doesn't ask you how you react, how you behave during the crisis back then, 10 or 12 years ago. And how have you been behaving in terms of your investment for the last 10 years until now in the face of the next crisis? Now, and this human nature and behavior also bring me back to my very initial statement on why women are better investors than men. Now, there's a research on this. Okay, so basically, I'm going to tell you the 3 factors that's going to that support this statement. So basically, women are less ego-driven, not surprising. Okay, and women are less overconfident than men. All right. Now, that's this survey done on 700 men, and there's 3 questions, and 93% of the men think that, all right, they're friendlier than any of the guys out there on the streets. Okay, and 95% of them, the same group of people, the men, feels that they are smarter, okay, than than the rest of their peers. And amazingly, 95% of these men also thinks that they are better looking than their friends. Okay, so what's the conclusion of this? It just concludes that men in general thinks that we are probably about 2 sit-ups away from dating a supermodel, right? So that shows that confidence in men that we have. And of course, we also look at a 3rd factor, that women are less hormonally challenged than men, because men has 10 times testosterone of women. And if you couple that with winning, let's say if you're doing well in the stock market, that turns you into very aggressive and starts to make you less intelligent, I would say. All right. Now, having said that, all right, with all due respect to the men out there, if you intend to challenge what I've just said, all right, I have this small little mathematical test for you. So listen on, okay? It's just take you about 3 seconds to get the answer to this. Okay, so here comes the question. Imagine a pond of lily pads, the leaves of the lily, that are growing and doubling every day. On day 48, the pond is full. Now, on what day is the pond half full of that lily pads? You have 3 seconds.
I have the answer, but what about our panelist?
All right. So,
guys, so yeah.
okay, I saw Jonas. Okay, so if your answer is 24 or any answers like 12 and stuff, it's good to leave that investment to your wife and your missus and your partners. Okay, 47 is the correct answer. If you get the correct answer at 47, you get to keep the money then, right? Okay, so these are the things that we do with our RMs as well to make them realize that, hey, I need to know how do I behave, okay, and under what circumstances do I behave differently in order to curate or rather to customize that, tailor that wealth solutions for our clients. Yeah. All right, thank you.
And it reminds me of an iconic advertising from Dove. And this was about women underestimating themselves, especially when it comes to looks. and Dove created an advertising wherein they were actually talking to a woman, asking her that describe to an artist how do you look, and when the artist created a sketch of them as they described themselves, it was a prettier version of what they are. Sorry, not a prettier version, but an uglier version of what they are. And then when they compare, they were like, oh, actually, I underestimate myself. And that's how Dove started going into more of the brand purpose. So yes, completely contradictory to what you mentioned, but something that stands true because of the difference between gender. All right, let's go to the next one, guys. We also have some questions coming in from the audiences. So we'll go to the next one quickly and then go to audiences. We have about 88 participants right now. So guys, please do ask your questions. All right, so let's go to the next trend and the last one, which is all about robo advisors. Now, robo advisors have been around for a while. It's not new, and their premise has been that can you let AI and machine learning do the magic and look at sort of you come in with the risk appetite, whether it's high or low, and then let the robo advisor do the magic. They have started to prop up again, and it's purely because of the fact that people are saying that how do I sort of get more illusion of control over my investments, and maybe robo advisor is the answer to it. That robo advisor is more sort of unemotional, so maybe I can hedge my bets properly and get some more return than how I personally would have invested for. That's a trend that came in. And then we also saw that these robo advisors, there are many companies out there talking about it. So how these trends are picking up right now. And we saw that some of these banks are also being mentioned. Robo advisors really peaked in February. And this was a time when a lot of people were taking their money out of stock market because of the crash, and it was starting to go to Europe side. So what are your views on these trends that are coming in around robo advisors?
I can start giving a little bit perspective. And Prashant, you're right. Robo advisory, it's becoming a little bit more prevalent in Asia. Even in the Western worlds, US and Europe, I wouldn't say they are the majority. They're still playing catch up to traditional, but they're definitely becoming a bigger part of how to invest. Now, the way I think about robo advising or robo investments is that I think if we all can buy something, buy an investment, understand the logic why we buy, and have the patience and also the interest to keep checking on that investment, because you can't just buy and then forget nowadays. Things change all the time, right? Imagine if you had bought an airline stock or a cruise company stock a year ago, right? You would have to figure out now today what to do with it, right? So if you are able to do all this, buy, have patience, and have the interest to continually check on that investments, then you actually don't even need robo-advisory. You do it yourself. So robo-advisory came about and say, hey, maybe you don't have the ability to or interest to make the changes. We'll provide you some algorithm to help you with that. But what happens is you completely let go. You're not driving anymore. You're giving the keys, or you're passing the keys over to them. And what we find, or what we've seen, is that people are still uncomfortable to say, you know what, I'm out. I'm outsourcing 100%, because they still have this inkling of, hey, I want to know what's going on. Maybe I want to buy a little bit of X, a little bit of Y. So what we have seen that is very successful is a combination of both robo-advisory as part of it, but also having whether it's relationship managers, whether it's bankers, whether it's financial advisors, human, let's just call it human, a friend, to also be there to guide you. Because using the last crisis in March and February, March and April, when that happened, your robo-advisory could have told you, don't do anything. In fact, buy into things that have gone down in value. Emotionally, you can't, most of us, it's very hard for us to buy something that has gone down in value. So what we would try to do is fight against that. So, just because the computer tells you something, doesn't mean you're going to follow it. That's where you have that human nature, someone that has seen, good times, bad times, lousy time, to be able to say, hey, Mr. and Mrs., here's what's happening. Here's our options. Here's what we should do. And here's my guidance. And combine that with some sort of robo-advisory, I think that's the better solution rather than a 100% robo, because it's very against the human nature. That's what we're seeing.
Beautifully put, Alfred. Let's go to Casey and David.
Okay, I kind of agree more with Alfred on that. Having a hybrid model of having robo-advisory and the financial advisors together. Because I think as individuals have increasingly gained more control of their financial lives, they have turned to very diverse and complex mix of providers to help them manage this increased responsibility. Now, having said that, I think the main purpose of having a robo-advisory, we could eliminate a lot of the investment errors, okay, like confidence, emotion, because I think investors tend to confuse emotion with risk management, right? Because when you look at long-term investment, you look at diversification of portfolios, you feel that, oh, it's boring. But in real fact, it helps to mitigate your risk, okay, and to lift the returns as well. But of course, as what Alfred has mentioned, we also want to humanize investor experience as well, because how comfortable are you to place a 2 million, say a 2 million investment solely by a robo advisory? So you need somebody to be there to give you that assurance or that validation as well. Now, having said that, of course, on the flip side, in cases where we see like a crisis right now, where the robo advisory would probably go for, let's say, in the algorithm where you go for value investment, and you as a human investor, you probably will be a bit resistant, and that's where your advisor would intervene and try to give you that assurance and tells you or guide you along on how you should progress with your investment portfolio. So I totally agree that we should have a hybrid models, yeah, in the banking. David?
Okay, so I believe we covered the cognitive bias that the investors have in terms of how they view risk. We actually see how effective or not effective the robo advisors is. But I guess one last thing we should highlight is robo advisors, right, only came post 2007 crisis. I mean, they only took shape after that. So what we can say is it hasn't been tested through a recession yet. There's no such test being done. All the algorithms that were inputted to the system or the AI system, right, were actually during the normal days of trading, where we see like probably the Dow Jones is trading at a 200 to 300 range a day. We don't see it being recorded like the Monday 1,000 point surge just based on some positive news about a vaccine discovery, but it's not really credible yet. So these are the things that hasn't been tested. Yes, it may be viable, but maybe in next 10 years or 20 years. But right now, we do see it's still in the infant stage. We are looking at it. I mean, to be honest, RHB is looking at it, but it's more like we don't think that it can be as a standalone product. Okay, one example of how it feels. Okay, we have one of the pioneers in robo advisors. I think it's Smartly. It actually failed in March this year. So these are the things we are looking at, because it doesn't really incorporate what is happening in the market. This instantaneous data reconciliation, and also like the human touch that Alfred and Casey has mentioned. Do we really need it? I would say yes. I mean, many of our clients are actually coming back to our RMs and asking why despite the negative US data in the market, right, economic data, how is it that the indexes are still surging? Is it an overbought market? Is it like a fear of missing out already? So these are the things that we need to address with our clients. And here is where we kind of add value to the proposition and so clarify these doubts with our clients to stay firm, stay invested. So these are the kind of I would say the differentiate, something that a Robo Advisors couldn't provide. So yeah, that kind of sums up the entire thing that we are discussing.
Thanks, David. We also have some questions. So I'll just talk about the questions and get some of your responses. In terms of time, we are 9 minutes away from 2 o'clock. So one of the questions is around, will Trump attempting to push for negative interest environment, would it impact or affect the outlook of US market? Anyone would like to comment?
Maybe I'll go. Oh, Alfred, yeah.
No, mine will be a very short answer. I think Trump has actually come out very vocal to say he's not a fan of negative interest rates. I think the Fed Chairman Powell has also come out to say that US, at least at this time, are not looking at negative interest rates. And I think part of the reason is because if you look at negative interest rates in Europe and Japan, have they worked? And the answer is it's not 100% yes, it's not 100% no. It's actually more on the 100% or closer to the no than the yes. So that's the experiment that has happened, and I don't think the US is going in that direction, at least for now.
I mean that's, just to add on to Alfred, we do have the same views here. So in terms of our house view, our base case scenario that we are running right now is that we do not think that there will be a negative interest rate given the Fed Jerome Powell's direction. And so we think that if should the negative interest rate really kicks in, right, two main industry will be really hit. So the banks. So we don't really, okay, first thing we like what Alpha has mentioned, in terms of the Europe and Japanese market, we don't see it working. So if this were to be implemented in the US, right, banks will be affected because how they operate in terms of the loans and also the money turnover will be different. Second will be the insurers because they are actually mostly bond buyers. So this will affect the bond yields. So this is how we actually foresee the impact will be for the if should negative interest rate take place. But our base case, really pricing a very low probability of this happening at all.
Any views, Casey?
No, I have no very concrete views on whether a negative interest environment would be better for the economy. We do see negative yield bonds that out there. But how receptive are investors to that, which I don't think that most investors are very inclined. And of course, I'm pretty concerned about the long-term debt cycle that we're looking at. Because if there's a negative interest rate environment, then I think we are just trying to prolong how we're going to repay that debts that we are having right now. And you look at the US Treasury, they're going to roll out the 20-year Treasury. And that's going to put us, whatever we borrow now, that means effectively we're saying that we have a dollar less. We borrow $1 today, we have $1 less to spend in future because you're going to utilize that to pay off your debt. So with the negative interest rate yield, if I'm not earning anything out of it from my investment, and if inflation keeps on going up and my salary is not going to cope with the debt I'm having right now, then I think that will pose a very big problem. Yeah.
Ripple effects. And I'll take the last question because it's something that I guess most of the audiences would like to know. And that's why we want to give more time to the panelists to answer it. So the audience are asking that I want to get into the market now. What will be a good vehicle and market to focus on? And is there a good investment strategy to ride over this period? I'm sure you have views, so go take it away, guys.
Should I start the ball? I'll just start first, okay? So in terms of the market opportunities that we are seeing, over in RHB, right, during the January, we actually caught for a correction that was going to be in play before the COVID actually just came about. So we were actually been in a better position since we caught for a kind of temporary risk off. So from there on, when the Dow dipped to 20 and 30%, we caught for a rebuy-in again. And that's where we think that it was a good call with the current recovery. If you go to the market right now, we feel that there will be a certain correction coming in for the US market, and that'll be a short-term one. be it a kind of overvaluation in the Wall Street markets. That is one of the key factors that we're looking at. The second one we are looking at is probably some of the market consensus is there will be a second wave of infection. How would that be an impact right now to how we are seeing things? Should there be a second wave, right? We don't foresee it to be as worse as the first. Reason being, we are already kind of wary of what's the potential effect and how do we control in terms of the social distancing, in terms of the current vaccine that are actually in works, there are a lot of things that are actually in terms of stimulus measures. These will actually kind of sustain the drop rather than like the first wave where things just go crashing down to the bottom. So this is how we actually see it. There will be short-term volatility. If you were to go into a market right now, stay invested. We think that global investment opportunities are still there. In terms of the Asia region, we are quite skeptic there. We are taking on a different approach. Why so? If we are comparing the current crisis to the 2007 crisis, yes, China may lead the way in terms of the global recovery growth, but the rest of the Asia regions are still quite fragile due to the COVID-19. So we are actually positive on China or Chinese market, but not so on the entire Asia region. So for us to really kind of give a summarized call right now, it's actually global investments, global equity funds, and also the Chinese market, China A to be specific. So these are the two calls that we're actually having. The equity risk premium right now for the 12-month, over a 12-month horizon do look very attractive. And we foresee that this outperformance for equity over bonds will continue through 2021. So this is our take on the market right now.
Thanks, David.
I can go next. Let Casey wrap it up. So for us, as I mentioned, Aberdeen Standard Investments, we are producer of investments, right? We manufacture products, and we have investments from fixed income to equity to private markets to real estates to money market, everything that you can think of, right? So I mean, what is there opportunity in the market? Absolutely. But I think I would use this this exercise to give you a really boring answer, and I apologize in advance. I think you got to, number one, have your investment objective and your portfolio ready first, and then once that is taken care of, and you have a very diversified allocation, proper asset allocation, as far as what is out there, whether you're a value investor, whether you're a growth investor, there's a lot to go look for. I'll just piggyback on what David mentioned earlier, his view on China, his view on equities in China. We are a strong believer in China. In fact, we have the largest China A equity fund offshore, so outside of China. It's ballooned to $3 billion in AUM in just 5 years. The fund has only been around 5 years. And part of the reason is because this not the idea, but the reality of middle class in China continue to upgrade themselves. When you talk about China, a lot of people keep saying, I have missed the boat. I should have invested in China 20 years ago, 15 years ago. Why do I invest today when China's already prosperous? Everybody look at China, wow, they're doing good things and all that. But the reality is there's this middle class population in China that continuously want a better car, a better laptop, a better shoe, a better this, a better that. And they are looking internally rather than externally, meaning they are looking at companies in China to give them, to provide them with their needs and demands. So we're seeing a lot of very good Chinese domestic companies selling to local Chinese investors. So when you talk about concerns on, how about the US-China trade war before COVID, or how about the escalation of what's going on between China and US now because of COVID, the reality is the Chinese in China still wants to buy stuff, still believe in their local companies, and they are very strong, good local companies, which is the China A equity side. So that is one thing I'll add to David's point.
Thanks, Alfred. Over to you, Casey.
All right. I think in terms of what sectors, what kind of markets or vehicles to go into, I think there are tons and tons of information that we can get around. Banks are putting out their investment views. We are competing on that front to see which among of us can give a better investment calls. Now, having said that, at RHB, I think what we want to achieve here is we're going to have our relationship managers to be the gatekeeper for you. And of course, we wanted to expand in terms of our wealth solutions product suite, because we know that the affluent customers right now, they wanted something more than just simple or simplistic. They want it simple, yes, but they want a very diverse kind of product suite to cater to their needs. And we wanted to operate like what the private banking space is having right now, which is why we have actually very strategic partners in terms of bank assurance. We work with IFAs, and we have fund houses like Aberdeen and to be able to tap on, right? So these are the wealth solutions that we can cater for our clients, and we are still expanding on that. If you're talking about Robo Advisory and stuff, we do look into them, and we will continue to expand that space. But back to where David and Alfred has mentioned, I think in terms of vehicle or market to focus on, we still advocate diversification. So I think you have to go through, say, a crisis like now, and to see how you can better structure your portfolios. So my advice is that it's good to really sit down with your wealth advisors or your relationship managers to go through in terms of what you have been doing and how you have been doing, and so that we can customize and tailor a suite of wealth solutions for you. Yeah.
Thank you, Casey, and thanks, panelists, for sharing your views. And it was really informative, whether it's their analogies or it's your psychology analysis or actual real tips to the audiences out here. We do have more questions, but we are short of time now. So thanks a lot, panelists, and thanks a lot, audiences. We still have 80 plus people still sticking on after 2 o'clock. So thanks a lot for your time, and until next time. Thank you.
Thank you.
Thank you.